Jagdishwar Gattu is also joining us today for this conference. Uh, so I'll start with the business performance for the quarter. This quarter was definitely a very strong quarter across all dimensions of performance. Our revenues grew 1% sequentially and 3.4% year on year in constant currency. Our services revenue grew 1.6% sequentially and 3.4% year on year, again on constant currency. One of the big highlights of the quarter is our operating margins. We recorded an 18.5% operating margin, which is a 154 basis points improvement at the company level, and at the services level, the margins improved by 212 basis points. This margin improvement is primarily through driving efficiencies in our managed services engagement through automation and AI ops capabilities. We also significantly reduced our dependence on subcontractors. We used our own employees to replace subcontractors. And we also controlled some of the discretionary spend like travel and other costs during the quarter, which eventually has delivered an exceptional margin performance. Another very big highlight for this quarter is our bookings in this quarter is at an all-time high. And for your reference, the booking numbers that we share is the TCV of the net new deals. It does not include rate card deals. It does not include uh, renewals. All of that is not included. These are new contracts signed with customers. It's at an all-time high at $4 billion. This is a 154% growth from a quarter-on-quarter perspective and a 67% growth on a year-on-year basis. To get into some more details of our quarterly performance, our service revenue, IT and business services grew 4.6% on a year-on-year basis and 0.9% from a quarter-on-quarter perspective on a constant currency basis. Our engineering services delivered a very strong growth of 5% sequentially on a constant currency basis, including the ASAP acquisition that concluded on 31st of August. HCL software continues to grow well. They continue to deliver 3% plus ARR growth. From an overall revenue perspective, 3.6% year-on-year growth in constant currency in our HCL software business. Four of the verticals grew very well. Our retail CPG vertical grew 7.5% quarter on quarter, followed by telecom and media, which we had highlighted last quarter that it was weak, but this quarter telecom and media vertical has grown 6.2% quarter on quarter, which is again a fantastic performance. These are really attributed to very good execution of the deals that we won in the previous quarters, which is really translating to revenue. We continue to have a strong run in our financial services and our life sciences verticals, which all reported good growth, both sequentially and year-on-year perspective. In terms of geographies, our growth markets, which is really the markets outside Americas and Europe, which is really our Asia Pac, Japan, Middle East, and India market, delivered a growth of 6.1% on a sequential basis. And Americas and Europe both grew about 3.9% on a year-on-year basis, all in constant currency. Our attrition continues to trend down. It's at 14.2% on a quarter-on-quarter basis. It's a 2.1% drop, and it is the lowest that we have experienced since the first quarter of FY22. Our employee count decreased by 1% on a sequential basis because we have consciously not backfilled some attrition, because a lot of freshers whom we hired in the last 18 months, we are really, they've got trained, they've really become quite experienced in the client engagement, so we have largely backfilled our attrition through the freshers. I have another very happy news to share on an ESG front. EcoVadis has rated hcltech as a gold category. We are placed in the 94th percentile for our advanced sustainability performance. During this quarter, we also launched hcltech grants in Americas for the climate action. We've committed about $5 million over 5 years. This program will provide grants to NGOs uh, combating climate change and restoring ecosystems and biodiversity across Americas, which is our largest market. 64% of our revenue comes from there. Now, looking ahead, the next 2 quarters, we expect a very healthy sequential organic growth in our services business. This growth in normal times would have been considered extremely good because it includes a seasonally weak Q3 in the services business. However, for the entire year, when combined with the weak Q1, which we reported last quarter, and a good Q2 that we are reporting today, our overall growth will add up to 4.5 to 5.5% organic growth for services for fiscal 24. We won some very large deals and we've been successful in gaining share on both cost optimization deals and transformation deals. However, the market is still a little tepid on the discretionary spend. At the start of the year, we expected the discretionary spend would start coming back, partially at least, but with the continuing macros, spending has not come back the way we expected. So, from this perspective, our revenue guidance for the full year, including the contribution from ASAP acquisition and the HCL software business, we will end up in the range of 5 to 6% growth at the company level in this fiscal year, of course, on a constant currency basis. Our operating margins, we are confident to deliver within the stated guidance of 18 to 19%. And with that, I will request Pratik to cover some more details on our financials.
Thank you, CVK. I'll give you some numbers in rupees because that's the country we are all based out of. The hcltech revenue for the quarter came in at 26,672 crores, which is a 8% year-on-year growth. What CVK was talking about was constant currency and dollar terms. The rupee terms is 8%. HCL software was up 8.1% and services at 24,169 crores was up 8% year-on-year as well. Sequentially, on a Q-on-Q basis, it was up 2%. Within that, IT and business services grew at 9.5% year-on-year, and ERS grew at 1.7% year-on-year. ERS obviously went through a couple of tough quarters, but has shown a healthy organic growth, 1.6%, including ASAP 5% sequentially. EBITDA margin for the quarter was at 22.3%, which is an increase of 30 basis points year-on-year. And in rupee terms, it's up 9.6% year-on-year. EBIT margin is 18.5, which is 50 basis points above the 18% we had in September quarter last year. And in rupee terms, it's 11.5% growth. And net income profit after tax is a growth of 9.8% versus the same quarter last year. In percentage of revenue terms, it's at 14.4%, which is an increase of 20 basis points over last year. Our return on invested capital, ROIC, has improved quite notably due to our continuous focus on profitability and very proactively managing the capital efficiency. So the last 12 months ROIC stands at 32.2% for the company, which is up 350 basis points, 3.5 percentage points on a year-on-year basis. And within that, services is at ROIC of 39.4%, almost touching 40% now. And software at 16.2%. This was a quarter of exceptionally good cash generation, and on a LTM basis also it continues to demonstrate very healthy cash conversion. Operating cash flow came in at 10,800 crores and free cash flow at 10,231 crores for H1, being 147% of profit after tax and 139% of profit after tax, respectively. Our balance sheet remains very strong with gross cash of $2.85 billion and net cash at $2.56 billion. And this cash generation was made possible because we reduced our DSO by 5 full days and on a sequential basis, quarter on quarter, and year on year it was a reduction by 6 days. So that has enabled the cash conversion. For our shareholders, the last 12 months diluted EPS amounts to close to 57 rupees, 56.95 to be precise, which is an increase of 11.8% year on year and 2.3% sequentially. And the board has declared a dividend of 12 rupees for the quarter, up from the 10 rupees pace that we were following for the last 2 years. And now it is 12 rupees for the quarter. And the record date of which will be 20th October, which is next Friday. And the payment date will be 31st of October. And this 12 rupees, so on a last 12-month basis, it will become 50 rupees, which is a payout ratio of 88% versus the 57 rupees of EPS, which is aligned with our capital payout run. So with that, I'll hand over to Jags for some comments on the digital foundation.
Thank you, Pratik, and hello, everyone. Looking at the DFS business, we're delivering market-leading performance. And also, if I look at the pipeline, we're showing the strong pipeline also. While customers are looking for cost optimization, they want to achieve this cost optimization through tech transformation as well as they're relooking at this IT strategy, how we want to achieve. If I look at double-click a little bit of the DFS business, we are seeing growth in cloud and networks and next generation networks and also cybersecurity. If I see the cloud, now customers are relooking at this cloud adoption and migration strategy primarily from purpose-based cloud or more pragmatic approach. Our cloud smart portfolio will help them to achieve that particular purpose. Whereas if I take the network, next generation network services, there are two trends we're seeing. One is the enterprises want to transform their network, primarily looking at on the back of the edge development and hybrid development. And on the another track, telecom providers, they wanted to basically partner with providers like us and then deliver the best value for their end customers. And you have seen the example of Verizon in the last what we have announced. And if I take the cybersecurity as a service line, based on what is happening around the globe, there is enterprises definitely assigning a lot more budgets allocation to security, and we're seeing quite a good headroom in that particular area. As far as the cost is concerned, we're delivering already excellent world-class services powered by automation as well as our DryAce platform and infused by the generative AI. And we definitely see that it is a good from a cost structure perspective, as well as the quality of services and an experience from a customer point of view. So overall, net, when I see this is a good traction to grow the services revenues. On that note, I'm going to hand over to Ram.
Thank you, Jack. Good evening, everybody. I'll just add a couple of more details to what CVK has already called out. The people strength for this quarter closing is a 1% drop. It's 221,139. We did add 3,630 freshers. We broadly will be in line with our quarterly plan for the year. We closed the year with about 10,000 freshers addition for this year. Attrition, again, at 14.2%. It's one of the best years. about 2.1% lower than last quarter. More importantly, if we look at the attrition now, it's pretty much pre-COVID levels. So we can say that we have been through the journey of spike in attrition and are now down to the pre-COVID levels. So that's one of the highlights. Last quarter, we took a decision to defer the pay reviews by 1 quarter. So we will be going ahead with pay revisions this quarter effective October. So the decision that we took last time that our mid-managers and senior managers will not have a pay review this year, we will defer the cycle. That decision to skip the cycle for the mid and senior management remains. But for 90% of our employees, we will go ahead with the pay revision effective this month. So that's going to be part of this quarter's exercise. I'll just pause there. If there are any questions on any of the people-related stuff, we can pick that up in the Q&A session.
सर मेरा नाम अनुवेश रात है, मैं जी बिज़नेस से हूँ। सर पिछले क्वार्टर को अगर देखा जाए और इस क्वार्टर को भी देखा जाए तो आपका जो नेट एडिशन है नए लोगों को रिक्रूट करने का वो दोनों बार कम रहा है। आगे चलते हुए इस पूरे साल में आप कितना रिक्रूट करने चाहेंगे और ये जो कम हुआ है उसका रीज़न क्या था? दूसरा सवाल ये है कि आपका जो मैन्युफैक्चरिंग सेगमेंट है उसमें जो ग्रोथ है वो थोड़ा कम दिखता है, तो उसको आगे चलते हुए आप किस तरीके से सुधारने की प्रक्रिया में हैं?
Do you want me to take the headcount question? Yeah. Okay. I'm going to respond in English. I can speak Hindi, but maybe not as fluent, so I'll respond in English. It's true that the AMJ quarter and JAS quarter, there's been a 1% drop in headcount. So there are two ways to look at what's happening, right? One, last year, we added about 27,000 freshers. That's one of the highest fresher intake that we have had in the previous 4 years. So we've made a lot of investment in getting freshers added to the organization, and there's a lead time by when the freshers turn productive and billing starts. So that's one reason. The other reason that CVK called out is there's also a lot of focus on efficiency improvement within the organization. So that's those are two reasons why you see the headcount drop the way it is. Going forward, in terms of headcount, every quarter we just moderate our intake based on a number of things. Demand is one part of it. Attrition is also another significant part of it. So that's the reason I called out the attrition. It's the lowest in now almost 4 years. It's effectively the pre-COVID level. So, which is good news. If the attrition drops, it gives us a lot of stability. We don't need to spend too much time and effort trying to recruit. So those are the reasons why our headcount moves the way it moves. It's largely down to fresher addition and efficiencies.
Thank you, Ram. I can also speak in Hindi, but I want all of you to stay in the room. So I won't do that. So manufacturing vertical declined primarily because in some of the projects we have certain assets or materials like computers and equipments which are part of the projects. And if you see that component of the revenue has decreased. If you see our detailed P&L, it has decreased by about 25 million. And some of that is in the manufacturing segment. But if you look at the pure services, it continues to remain a healthy vertical for us. Thank you.
Hello. Hi, Saurav from Business Standard. Good evening. I would like to ask you, this is a big, there is a big revision in your revenue growth guidance for this year. What is the reason? Do you see pipeline conversion not happening at the speed you were expecting last quarter? And the other question is, if you minus the Verizon deal that you won, what is the scenario in telecom and tech vertical? Are you seeing the recovery that you were expecting?
Yeah. So if you see this quarter, as I announced, the telecom, media and entertainment segment has grown sequentially 6.2%, which is a very, very strong growth. This is, we have no contribution from the strategic partnership that we have announced in Verizon, which is going to come from 1st of November as we had announced. So our telecom business is going to grow really very, very strongly in this year. So we think that's really a extraordinary performance on the telecom segment. And your first question was on the overall guidance. If you really look at our performance in Q1, our revenue had declined. Q2 is 1% growth. Now, for the guidance that we have given, we need to still grow quite strongly in H2, including a very strong sequential growth in Q3, and on top of it, another good sequential growth in Q4. So really, the rest of the year is going to be very strong. And the reason for revising the guidance was first half has been much lesser than what we expected. So we have to build on top of it. And that is the reason we've guided. And given the guidance of 4 to 5% organic growth and 4.5 to 5.5% services growth, we will be delivering one of the highest growth in the industry, even in this uncertain macro environments.
Yeah, maybe I can just add. So, simple answer is it's really mathematics. Half the year is already over. Nobody can change that. At the revised guidance that we are giving, mathematics simple says 3 to 4% CQGR. So 3 to 4% in the next quarter and 3 to 4% in the next quarter. That is what will get us to the guidance. And that is what CVK mentioned in his opening comments is a very attractive growth in any normal time also, and certainly in these times.
Yeah.
Hi, sir. My name is Danish Anand. I'm from CNBC TV 18. Sir, as far as your deal wins are concerned, when do you really feel that they will contribute to the growth? And what is your overall outlook on the second half?
Yeah. So basically, it's the same response. Second half is we expect it to be very strong. As we mentioned, the strategic partnership with Verizon, which is one of the largest deals that we signed, the revenue will start flowing from 1st of November. And even in addition to Verizon, we are going to see a good growth in Q3 and Q4. Even though Q3 is a seasonally weak quarter, some of the ramp-ups that we have done will help us achieve pretty strong growth. As Prateek said, 3 to 4% is the number that we are looking at in Q3 and Q4. So I think our second half is going to be very strong.
Hi.
We can hear you, but if you could be louder.
Hi, Annapurna here from ET. Could you talk a bit about what has the client demand sentiment been like? Do you think they'll continue to spend on large deals like we've seen? And about your campus placement plans, Infosys is not going for them, so what is your approach going to be? And if you could, I think you mentioned the numbers of the freshers onboarded. Could you please repeat the numbers on the onboarded freshers, and what is the number of freshers onboarded this fiscal so far?
Yeah. I'll answer the business question, and Ram can follow it up with the responses on the people front. I mean, client spend is really focused on what we call a zero-cost transformation, which means they want us to take over a certain scope, make it much more efficient, and whatever savings that they get from that, they want to reinvest in transformation. Right? That is a broad theme. Even though a lot of deals, industry is talking about cost optimization deals, it is not just a pure play cost optimization. It is really you bring in a certain level of transformation which really takes out cost. That is the kind of spend pattern that we are looking at. And Ram can answer the rest of the questions.
Sure. Hi. Freshers, this fiscal we have added about 5,200. Last quarter we reported about 1,600. This quarter about 3,630. Usually the JAS quarter has a higher intake. We'll close the year at about 10,000. Right. So whatever we did in H1, we'll do equivalent numbers in H2. So it'll be about 10,000. In terms of campus programs and visit to campus, we continue the program. There's no change in plan. As we speak, my colleagues are all active visiting campuses. So that program continues. There's no change to that program. I hope I'm audible. If I'm not audible, somebody needs to. Yeah.
Sorry.
Hi, what is the impact of the war in West Asia right now, and how many people do you have at the moment in Israel?
It's a very small number, 100 plus people maybe. There's no business impact at this point.
Yeah, if there are no more questions, we'll move to yeah.
Are you seeing any pricing pressure due to the macroeconomic conditions?
That's a very generic question, but I think it all depends on very situational. It's very situational. I would say, I mean, with whatever we have seen, pricing has been stable.
Okay, no more questions. I'll pass it on to Siddharth to connect us to people who've joined us virtually. Siddharth, over to you.
Thank you, Ashutosh. Ladies and gentlemen, in case you are on the computer system and want to ask a question, please click on the raise hand icon and we will unmute your line. The first question for today we have from Setu Raman from Reuters. Setu, please go ahead.
Gentlemen, just wanted to check. So the deal flow has been like pretty strong. But on the other hand, like I understand that you mentioned that the first half was softer than expected. But the guidance cut is also like pretty strong, right? Like so from 6 to 8%, 4 to 5%. So I just want to know, is this basically reflecting the uncertain situation that is going on for all your peers? That is my first question. And like, at what point do you expect to see double-digit revenue growth? So that is my second question. And also, I also want to know. So you mentioned that the deals were like sort of net new that you had given. So these are like long-term ones, or like I understand Verizon is a long-term one. So I also want to know like how is the deal environment looking for you? Like, is it more of a short-term deals or one-off long-term deals of sort of that kind? And final question is, how do you have you witnessed any ramp downs or project cancellations that you signed during the pandemic period? Because so you had one large number of deals during pandemic. All of them were digital transformation. A lot of your peers have been saying that there have been ramp downs and discretionary spending cuts. So these are some of mine. Thank you.
Yeah, Setu, I'm just hoping that I'll remember all your questions, but let me start with the first one. First one, you talked about the bookings and all that, and why is the guidance reduced? As we said, it's really a first half problem. First half has been overall soft, and the second half, as we highlighted and Pratik also highlighted, we expect a very strong second half. And when we talk about guidance, it does factor in all the aspects. The discretionary spend, as I mentioned, is still very soft. We have not seen the discretionary spend pick up like we anticipated. But the bookings that we have done in the last quarter and even the prior quarter, some of them will convert into revenue. And that followed by the large deal execution, we will deliver a solid growth in Q3 and Q4. Then your next question was...
when is the double digit?
Yeah, double-digit growth is right now we are very focused on financial year 24, for which we have given a total guidance of 5 to 6%. So I think generally the environment is quite volatile, so it's very difficult to take a call from a long-term perspective. We are very focused on executing this financial year, and in April we'll give you a perspective of what the growth after that is going to be.
There was one on deal tenure.
Yeah, deal tenure is, I think we have a $4 billion of booking. As you called out, Verizon is a strategic partnership. It's a 6-year term. But all others deals you can classify into two categories. One is long-term deals. I think our maximum deal is 5 years is the tenure of the deal, and the rest of the deals that we have signed. And every quarter we also sign a number of small deals. Small deals it adds up to some decent number. These are smaller projects. They're typically maybe less than 2 years kind of tenure. Thank you.
Thank you. Our next question is from the line of Anisha from ET Now. Anisha, please go ahead.
Organic growth in the ERN segment, and I beg your pardon if you mentioned it already, but just wanted to get that number. And the other question, CVK, is on the deal pipeline. Yes, the conversion this time has been very strong at $4 billion, but is that the run rate we should envisage going forward? Prateek, a question for you on the win rates and the pricing, how both of them are panning out. Would you go ahead and say that you are increasing your market share in any way? And lastly, Aparava, a question to you, more of a clarification. Did you say that you're going to add 10,000 freshers in this year?
Yeah, so let me start. I think your first question was the organic growth in ERS. So overall growth is 5% sequential, and organic growth is 1.6% in engineering services. And Ram, you can answer the other questions.
Okay, so I am Ram.
Change from Papa. There was one more question.
Yeah, so freshers, yes, for this year, you have got it right. We'll be targeting 10,000.
And Anisha, on your question, I mean, we didn't get the line very clear, especially at the beginning, but your question on the pricing, we already mentioned that it remains stable, so it is not, and you had the other question about, is the 4 billion going to be sustained? We would love it to be, but we are certainly not guiding. Our run rate for the last almost 2-3 years has been 2 to 2.5 kind of a range. That would be more realistic to pencil in, but we would love it if it is 4 every quarter.
And just to clarify that even a 2 billion or 2.5 billion run rate is all net new deals, net new firm contracts. It is not any rate card or any kind of framework kind of contract. These are firm contracts that we have.
Even,
good.
Even for the renewals that we have, we take only the incremental TCV to give you this number.
Okay, thank you, gentlemen. And let me apologize, Ram. It's just the muscle memory to call out Aparav's name.
Yeah, that's fine.
Appreciate.
That's okay. That's okay.
And
That's
just
fine.
one question, since you talked about the renewal rate as well, Prateek. How have the renewals been? I mean, of course, the win rate for the fresh new deal win is strong at 4 billion. What about renewals?
Actually, renewals has been very strong this quarter. We don't call out the renewal TCV, but pretty much all the deals that have come up for renewal where signatures have happened, we've concluded in our favor. Okay. There are more? Okay.
Hello, am I audible?
Yeah, the next question is from Prasun from PTI. Prasun, please go ahead.
Hi, my question to me when you spoke about salary revision part. If you can repeat that, and in addition to that, I have a question. Have you seen any trend of clients shifting their employees on HCL payrolls when they are outsourcing you some deal? These are two questions for Mr. Ramachandran, and then I have follow-up questions with the panel.
Okay. You're calling out my name. I lost what your first question is. I'll first address the second question.
So better to call him Appa only.
Okay. So the pay revision, So last quarter we said we took two decisions. One, we said our middle managers and senior managers will skip the pay revision cycle this year. That decision stays. The second decision that we took is for the rest of our colleagues, we will review it in this quarter, which is a decision that we have taken, that we will go ahead with the pay revision. And that's effectively covering 90% of our employees. Right, so that's about the pay. Outsourcing deals, are there employees who will transfer over from client organizations to hcltech? Yes. Some of the large outsourcing contracts, we will have what we call as employee rebadging. It happens, and we'll continue to do that.
And that is not a new trend. It's always been there. Last 20 years, we've seen some clients transfer some of the employees as a part of the outsourcing deals. Thank you.
Have you seen any change in the trend in terms of geographies from where most of the employees are coming onto your payrolls?
I wouldn't say there's any change in that trend. It happens largely across all three major markets for us. US, Europe, and parts of Asia Pacific will continue to see that. That's been the trend, and that's what we continue to see. I don't see any change in that.
I'm not sure where your questions are coming from, but just to keep in mind that it is important for the continuity of the quality of the project and the work. It is good that employees that were doing the work earlier get transferred to us. And of course, we will make it better and transform, and all the digital transformation that Jag spoke about is what we are best known for.
Thank you. The next question is from the line of Shovik Das from Mint. Shovik, please go ahead.
Hi, gentlemen. Just wanted to understand the overall generative AI landscape. Is that translating to business, and is that translating to quantifiable revenue for HCL? And also, when it comes to fresher hiring, are you seeing enough onboarding of projects to warrant new hires, or would you also look at utilizing your bench?
Yes, on generative AI, there is quite a strong traction. Pretty much in every client conversation, we discuss about how generative AI can help the current execution, as well as a lot of new ideas on how it can help our clients improve the quality of service, reduce their cost, efficiency, all of that. So today we have over 100 opportunities that we are working on, but most of them are proof of concepts. They are sub $500,000, sub $1 million type of opportunities. And this quarter we've called out two things for one of the very large software majors. We've been selected as a partner to leverage generative AI in their product testing and sustenance efforts. We're trying to deploy generative AI through a private language model to improve the resolution rates and speed, efficiency, all of that. We are also, we signed with the bank to use generative AI to improve their risk and compliance efforts, which is a very, very big effort in a lot of financial services firms. So we are already seeing deals getting signed, but it is as expected in any new technology, it always starts with a proof of concept, and then it will scale over a period of time. But we continue to see tremendous traction on this front in the market.
We have one last question from Debangana from Money Control. Debangana, please go ahead.
Hello, gentlemen. I just have one question. So your operating margins have improved a lot this quarter. So just wanted to get an understanding, is this the level that you're expecting to continue in the upcoming quarters as well? And also, what levers do you have in place to drive that kind of an improvement?
Yeah. So, Debangana, our guidance for the year stays at the same 18 to 19%. So that's the number for the year. So we were lower in the first quarter, we've made it up in the second, and we'll sort of stay at these kind of levels is what we expect. to be in the 18 to 19 range that we already talked about.
No more questions online.
Yeah, yeah.
Over to you, Ashutosh.
Just one last one is one for Ram and probably one for you, CVK. What is the variable payout for the quarter is for Ram, and for CVK, can you please give some color on the market sentiment in Europe and North America?
So I think quarterly variable pay, I think we first need to put some context to it. In terms of the overall compensation package, the quarterly variable pay is 3% of the annual compensation of the individual. It's not a big portion, right? So this quarter will continue with our quarterly variable pay. So all our colleagues will get their quarterly variable pay this quarter. Majority of them should see their quarterly variable pay to be upwards of 85%.
Yeah, in terms of market sentiment, of course, it's generally reflected in two metrics. One is the booking and the second one is pipeline. So bookings, as you saw, it's been an all-time high. And if you look at the pipeline last quarter, if you recall, I said our pipeline is really at the highest levels. It's come down a little bit because this quarter we had some good bookings, but it is still very close to the peak kind of pipelines. And that is quite representative in US and in Europe. So we don't see one or other having a stronger or weaker demand. Our pipeline is in line with our revenue proportion. So generally, the most of the deals are driven by efficiency-led opportunities, but efficiency does not come just by labor arbitrage kind of solutions. You need to use technology. You need to use leverage automation, AI ops, all the technologies that we have, and the platforms that we have to deliver high quality service at a much more efficient kind of operating levers. So that's really the predominant theme in the trends in the market. Yeah. So with that, thank you everyone for joining us and really appreciate your time. Have a good evening.
Thank you.
Thank you.
Thank you.
Thank you.
What looks good to you on the charts?
So I think first stock that we are focusing is Dixon. Very strong buying action since last couple of trading session. It's a third consecutive day we have seen that stock is forming higher high-low formation, and stock is now looking to cross its previous swing high. In the last session, very strong buying action was there. So I think Dixon Tech one can look at to buy. We are projecting target of 5350, 400 in the continuation of this uptrend. One can keep stop loss at around 5210 to buy Dixon. Another stock is from the pharma space that you have already discussed, that mentioned that we are seeing that a lot of traction on the pharma space. Aurobindo Pharma is looking very promising, and I think if stock holds above 900 level in the today's session, then possibly this stock can show good uptick towards 930, 935 zone. One can buy this stock with stop loss of 882. The third stock is from chemical or agrochemical theme, that is UPL. After a decent corrective move, now stock is recovering. Stock is now holding above 50-day moving average. Short covering action was there since last couple of trading session. So we expect that UPL can scale up to the level of 650, 655. One can buy UPL with stop loss of 618.
If you like the video, do like, comment, share and subscribe.
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, and on this special edition, our focus is going to be on the real estate sector and the soaring prices that you've been witnessing, the outlook there is, and whether this is the right time to look at real estate as an investment option as well. Remember, despite the increasing property prices, the rising home loan rates, the upcycle in the residential real estate industry, which began in the year 2021-2022, is now expected to lead to decadal high sales in the year 2023. On D Street as well, investors are betting big on the boom, with the Nifty Realty Index now trading at a 15-year high level as well. To understand what is the outlook on the real estate sector, the soaring prices, and whether this is the right time for you to look at real estate as an investment option, joining in is a very special guest with me. Ashwinder R. Singh, the CEO of Residential Bhartiya Urban and co-chairman of the CII Committee on Real Estate, now joins in. Welcome, sir, and thank you so much for taking the time out for this discussion. Let me first begin by saying that the real estate space is clearly buzzing, and we all can see that. There's news every now and then that builders are seeing highest ever quarterly booking values. They're achieving pre-sales guidance right ahead of expectations, selling flats on day one on project launches as well. And the news that is now giving us some kind of a concern is the soaring prices. The news reports that we woke up to this morning were that even in Delhi NCR, especially in places like Gurgaon, the circle rates are shooting up, especially for the high demand areas as well. So let me first begin by understanding from you, are you also seeing that happen, not just in Delhi NCR, but across India, the soaring prices along with the demand?
Thank you, Sakshi, for getting me on the show. And you have a very pertinent topic to discuss. Yes, this trend is prevalent across the country, whether it is Delhi NCR, whether it is Mumbai, Pune, Bangalore, Hyderabad. All the top 7 cities are looking at this trend. The absorption is at an all-time high. Capital values are at an all-time high. And the good part is that it is the end user that is propelling the demand. So it is not a very speculative environment. And that is why this seems to be a very sustainable trend that is going to be there in the real estate industry. People are looking at buying their own home, not just as a mere investment asset class, because gone are the days when you can discuss that whether you should invest in equity, gold, or real estate. When it comes to your home, it has become an important asset class. People are buying it to stay there. And after all that went through during the pandemic, people are looking at larger homes, and that is why the overall demand of homes, there was a recent report, overall demand of homes which are more than 1 crore for the first time is much higher than the demand of affordable homes. So yes, this is a very unique trend which is there, and it seems to be continuing.
It seems to be continuing. I'll get down to the demand even going forward, but let's stick to the prices for now. The news report that suggested was that per square feet prices for the high-end apartments in Gurugram and even the bungalows in Lutyens, Delhi are even surging for over 1 lakh rupees per square feet. That actually means that in Gurugram, say for instance, a flat of 10,000 square feet at the Camellias in the DLF in Millennium City's Golf Course Road is now over 100 crore rupees. A flat selling for 100 crore rupees in Gurugram. Is this for real? And why such a sudden burst? Because this same flat for 10,000 square feet just about a few months ago was priced at around 60 crore rupees. Just within sudden few months, why has the prices soared so much?
So just to put it in perspective, you're right that 65 odd crore was a bare shell apartment, and this apartment that we are all talking about, which is in news, is a fully furnished apartment. So you can, kind of put a markup of another 20%. But yes, the price is 1 lakh rupees a square feet for this particular apartment. And you need to understand about this particular segment, because you mentioned about Lutyens, Delhi, Golf Links, and now comparing it within Camellias or a Magnolias or a Aralias. That is how it started. So this particular segment is a segment which is very status conscious. And if you look at the latest report, in India itself, there are more than 25,000 people who have a net worth of $125 million or more. Now, the issue is that they are looking at buying these properties obviously for end use, but they also want to stay in a particular ecosystem where there are very similar profile of people staying there. And within that particular ecosystem, if you look at, Camellia, there are a total of 429 apartments of Camellia. And now, in that case, the supply is limited, and the person who has to buy that home has already thought of it that they are going to buy it and buy a Camellias. It is like an iPhone. If somebody has decided to buy an iPhone, he's going to buy an iPhone irrespective of the price. So there is a limited supply. Obviously, it's only 420 apartments and there are people who can afford it. The beauty is that these are these kinds of residential societies which cannot be replicated. Now, this particular Camellias on a golf course road, you cannot have another residential society that can be replicated like it in Gurugram, because you will not get the same micro market there. You will not get the same view on the golf course, and you will not get the same ecosystem. The other thing also we have to understand is sometimes these properties get traded at such high rates because the buyer has a capital gain to offset. So they obviously have disposable income on their hand, and they are very clear that is what they want and that is where they want to go and stay. But then they have certain other requirements, and looking at the size of capital gains, then they short down or shortlist properties like this. And yes, if you look at Lutyens, if you look at Golf Links, if you look at these properties in Gurugram, these are such neighborhoods which attract a particular target segment who are looking at these kind of ecosystems and are ready to pay any amount of price. And they don't look at per square feet price. They look at box pricing. So they have a budget, and if that particular property is fitting into that budget, they go ahead and they buy it. And it kind of, takes care of whatever needs that they have and whatever the way they want to position themselves and the kind of lifestyle they want to have. Now, if you look at the clubhouse of Camellia, the Camellia clubhouse is 160,000 square feet in a double level clubhouse, which you will not get anywhere. So the experience is also phenomenal. Many people used to tell me that, sir, you should go and see that clubhouse because it's like a Oberoi hotel, kind of transported into that place. So there are certain things that are given to these people who are very clear what they want and how they want to be perceived in the society. So that's how it is. They don't look at per square feet prices.
Okay, this is for Mr. Moneybags, who has no end of those money bags right there, the Richie Rich. So limited supply, huge demand perhaps is leading to this. But the next question would be that, we used to only hear about these kind of rates coming in from the Tony neighborhoods of Mumbai, for example, Malabar Hill, Pali Hill, these kind of places. Peta Road is where we used to see for such bungalows. Are you going to see ever a scenario emerging that Delhi NCR circle rates could perhaps overshoot those of Mumbai?
That seems tough because Mumbai is a very linear city, and it is a landlocked city, and there is one side there is sea, and that is the way that city has grown. And there are multiple reasons for that city's real estate to be always very high because of multiple industries that focus on that particular city. But yes, now it is competing because, see, if I give you a perspective, again, let's look at a target segment, which is the target segment of the rich. The new report says that there are $800,000 millionaires in India. And between 21 and 22, there were $5 lakh millionaires which were added in India. Out of that $5 lakh millionaire, now 25% is Delhi NCR and maybe 35-40% is Mumbai. So there is a overall the economy is doing well, the incomes are growing, the way India is situated right now, and vis-a-vis the global things that are happening across the globe, there is a favorable environment. But yes, the real estate prices, I feel, are now really becoming high, and I feel they should stop before we kind of get into something where suddenly there is a global incident that happens, or there is some other incident that happens which kind of brings in a sharp kind of a turn in the way things are going. However, in the residential space, because there is a strong demand from the first time home buyer, I think the demand will continue and the prices overall should hold up at a particular level, and they will not increase the way they are increasing in this super duper luxury segment.
I actually wanted to ask you this. I'm glad that you pointed this out, that how sustainable is the kind of price rise that we are seeing in the real estate space. You know, world over, we are looking at several uncertainties. There are geopolitical tensions that are surrounding. In China, there is a real estate bubble that has happened. We have seen the biggest of their real estate players crashing clearly. How do we see, in that context, the way Indian real estate prices are growing, the demand is growing at that point in time now?
Sakshi, you've highlighted some important factors, and those factors itself define the way our real estate market looks like. Our real estate market looks like more sustainable. Now, there are reasons for it. Number one reason is, for the 4 times in a row, the repo rate has not been increased. So the interest rate now is stabilized. The second important point is that the overall scenario of developers, their debt in the last 2 years has gone down, because whatever inventories that were there, which were not selling, and because of which the developers were under pressure, those inventories were sold, and actually they have not taken as much debt as they can take. Their capacity to take debt today is far more than what they have taken. And the debt that they are taking, especially in construction finance, if you talk to the housing finance companies, the debt they are taking, the repayment of the debt is very fast, and the books of housing finance companies are not growing because the sales are happening. Now, when the sale happens, and the third and most important aspect is RERA. RERA has given such a beautiful strength to the real estate industry that you know that a new project, 70% of the money goes into an escrow account. And then when you take a construction finance, construction finance is linked with the home sales. Now, the moment home sales happen, the amount of money that is taken from loan gets swept back by the construction finance company. So what is happening is, right now, the construction finance companies are saying we are not able to grow the book, because the moment we lend, the sales happen and the money is getting returned to us. So debt is not very high. The demand of first-time home buyers is good. The demand of people who are upgrading into larger apartments is very good. The interest rates are stable. Our overall environment vis-a-vis the global geopolitical situation is far more better. Our domestic demand is very high. In the last 10 days, when the FIs kind of sold 1,000 to 1,500 crores, the domestic funds bought 1,000 to 200 crores. So the money getting into capital markets is also getting supported by the domestic funds. So overall, we are in a very unique, blessed position right now, and I hope that this continues.
Okay. What is your outlook on the festive demand, sir? What is the kind of trend that you are seeing across India? Like you pointed out, it was higher demand for luxury homes until so far. Are we also going to see the affordable segment pick up in the upcoming festive season?
Of course. See, I don't think now we are in a situation where the festive seasons are really making an impact, because earlier what was happening was, before 2020, Sakshi, festive season was seen as a time when the developers would come out with new schemes, try and entice people and give them great offers, and the demand was less than the supply. But after 2022, the demand is more than the supply. And my point is that we should not see the rates going higher. And obviously, in India, the festive season is also seen as a time from the home buyer, as an auspicious time to buy, whether it is Navratras, Dussehra, Diwali. So that natural push is there, where some of the home buyers did not buy earlier, and they will come and they would want to buy it in the festive season. And obviously, there will be some sort of offer that will be going on for them, which kind of pushes them to not delay the decision and buy the buy the home or the property that they are looking at. My current thing is that the supply is lesser than the demand, and as you rightly said, the moment launches are happening, the launches are getting sold in a very quick, swift manner. And I would expect some good number of launches happening across NCR, Mumbai, Pune, Bangalore, Hyderabad, so that it can support the pent-up demand. And this trend will continue. Obviously, the festive season will give some support and it will only act as a catalyst, because overall the scenario is that the demand is handsome, and this kind of scenario will remain for another 2-3 years. People are saying 4, 5, 6 years, but I'm saying that yes, a minimum of 2-3 years, this kind of environment where demand is robust
Okay.
and is more than the supply will continue in the real estate sector, especially the residential sector.
Okay, what would you really suggest the buyers right now who've been sitting on the fence, waiting for some kind of a conducive environment at this point in time, for rate reduction to happen, perhaps prices to cool off a little bit? What would you suggest to them? Those of buyers who are looking for their own properties where they want to reside themselves, or for those who want to just invest in as a investment opportunity in real estate now?
See, what is happening is on the investment side, Sakshi, if I give you an example of Bangalore, currently Bangalore, the rental yields are anywhere between 3 to 6%, even higher, depending on the micro market that we are talking about. If you talk of an integrated township like the one that I work in and I lead, we have a rental yield of anywhere between 6 to 8%. So the investors can easily look at buying residential in areas where the rental yield is good. The home buyer needs to be very clear. My cheat sheet for the home buyer is very clear. You should please choose your channel partner very carefully. You should choose the developer very carefully. You should know the track record of the developer. You should personally go and visit the site. You should understand whether you want to shift in immediately or you want to shift after 2-3 years. Please figure out how much rent you are doing. You are already paying if you are in a rental accommodation. And if you want to buy an under construction property, what kind of EMIs you will pay. Obviously, in under construction properties, in the initial first 2 years, your EMIs are less. So you can kind of handle your rental EMI as well as your rentals as well as your EMI. Very important that you choose the location carefully. These days, infrastructures are improving. If you get a larger home and you have to go towards the outskirts of the city, and that part is well connected, for example, Hyderabad, people are going towards outside of the city because the infrastructure is great. The time being taken to come to CBD is not very high. So look for larger homes, look for spacious homes, look for a home which has an extra room where you can work from home, because work from home is going to be a reality. Be very careful. Don't get into a frenzy. Don't get into a FOMO mode that you will, have a fear of missing out. But you should have a JOMO mode, which is a joy of missing out. So happily look after figure out have a checklist, follow that checklist, and you will get your dream home.
All right. Well, many thanks, Mr. Singh, then, for being with us on this edition and discussing all these insights about the real estate sector and the outlook going forward from here. Robust demand to come in over the next 2 to 3 years to continue. Of course, the demand for luxury homes versus the affordable homes could also continue as a trend going forward, as a key insight from you. However, the prices at which and the rates at which these prices were rising may peak out at a sooner time than later at this point in time as well. The 3 key takeaways from you at this point. Many thanks for being with us on this special edition, and I hope all our viewers really got a sense of what the real estate sector is looking at as we look ahead into the festive season as well. Many thanks for tuning in, but do stay tuned on to Business Today Television for a whole lot more of updates coming in from the world of business and stock markets.
If you like the video, do like, comment, share and subscribe.
देखिए, देश के प्रसिद्ध उद्योगपति आदरणीय मुकेश अंबानी जी ने आज बद्रीनाथ और केदारनाथ धाम की यात्रा करी है और दोनों धामों में पूजा अर्चना करी और उनके साथ में उनके परिजन भी थे। और अंबानी जी ने बद्रीनाथ केदारनाथ मंदिर समिति को 5 करोड़ रुपए की धनराशि भी प्रदान की है और इसके लिए हम उनका आभार भी व्यक्त करते हैं। और मेरी कई विभिन्न जो मंदिर समिति के विभिन्न प्रोजेक्ट्स हैं जो प्रस्तावित हैं उनको लेकर के भी उनसे चर्चा हुई है और उन्होंने उन प्रोजेक्ट्स में हर संभव सहयोग का हमको आश्वासन भी दिया है।
If you like the video, do like, comment, share and subscribe.
Let me welcome Mr. N. Ganapathy Subramaniam, the Executive Director and COO at Tata Consultancy Services, who joins us live now. Welcome to the show. The headlines clearly talking about how there's been a bit of a stumble amid economic concerns as clients cut back on spending. Would you agree with those headlines?
Thank you for having me. It's always a pleasure to connect with you and your viewers. It's been a muted quarter from a revenue perspective. I think the macroeconomic situation and the geopolitical changes that are happening by the day meant that clients are a bit cautious about what they want to invest in, what they want to spend in. That created a muted revenue growth for the quarter. But however, we are pleased that we have improved the margins sequentially by 110 basis points and also a very strong order book in terms of the large programs, large deals at 11.3 billion came out much ahead of our own expectations. So overall, it's a good execution, disciplined execution from TCS in some trying circumstances. That's the way I will put it, Siddharth.
How long do you think these trying circumstances are likely to prevail?
It's very hard because even the economists are saying, I think, listening to your channel where one of the economists actually pointed out that the economy itself overall seemed to be resilient to recessionary and inflationary challenges. But however, the growth has been muted. And while growth projections have come for many markets, they're all below the historical average that they're all used to. So in that sense that there are going to be a certain amount of uncertainty. So our customers, what they are looking at right now is, if I'm going to go with a proposition or any project which is going to give a return on investment, which is very visible in, let's say, a quarter or two, then they want to execute those programs, right? While they continue on the long-term commitments that they made and they have not passed the long-term projects that we are executing. But then if I'm going to go with a proposal which is going to have a, let's say, a return on investment is going to be over 4 quarters or 5 quarters, then clearly they are not on priority right now, right? Understandably, because of the macro uncertainties and everything happens. And from our own TCS perspective, we calibrate our plans, our hiring plans, or what we will do internally and externally. We calibrate it on a 15-day basis.
Your EBIT margins have come in at 24.3%. What's your outlook for the remaining 2 quarters?
I think, if the top line is under somewhat of a stress, then it's important that we also look at the efficiency side of it. So we took some clear-cut actions in terms of improving the productivity, improving the utilization, cutting down on contract staff as opposed to, when we have a bench which is reasonably secured, reasonably high, and we trained all of them. So we replaced some of the contract staff. So those efficiencies levers is something that will continue, and that has delivered 110 basis points, and there will also there's a good chance that we will continue that in Q3 and Q4. So overall, margins should improve from where we are, but at the same time, what's going to pan out in Q3, which is a seasonably a weak quarter, with the furloughs, the number of working days being less, etc., is a challenge. But growth is as much an enabler to improve the margins, like the other parameters that I talked about.
Your order book has stayed strong, and you have also increased the guidance to around $9 to $10 billion. This was also the second highest TCV ever in a quarter. Which vertical drove this growth?
It's quite broad-based in terms of the overall order book. I think, two mega deals, the one from JLR and the one with BSNL, both are a little above $1 billion. So that they constitute the mega deals. But then North America clocked about $4 billion. Banking financial services clocked about $3 billion. The consumer group, which constitutes retail, travel, hospitality, and CPG segments, that constituted about $1.3 billion. So I think overall, I think it's fairly broad-based across markets and across verticals beyond what I said.
And how does the pipeline look like for the future?
Pipeline looks good. Look, when these are large deals, when we look at it, they take about 12 to 18 months to shape. The qualified pipeline that we have in major markets as well as emerging markets is quite strong. And we are working on many of those opportunities, and I think we are confident of good deal conversion. For the value propositions are clearly embedded with our new offering, which is we launched AI.cloud, which actually brings about cloud, digital technologies, artificial intelligence, deep learning, all of that together under one bucket. So which is actually being received very well by our customers. And we are putting that in the center of every opportunity that we are qualifying and the value proposition that we are crafting to our customers.
On a geography basis, the UK market was up 10.7% annually. When do you see the North American market kind of returning to its past glory?
It's difficult to say, and because it's a huge market for us. Almost 50% of our revenue comes from North America. So in that sense that we are waiting and watching that turnaround in that market. Manufacturing industry per se, it's done well and for North America. But banking, there are, while the banks' results themselves are good, but then there are sentiments on banking sector, which are whether it is related to savings or whether it is related to mortgages, they are not looking very positive. So the banking segment really looks at a certain amount of caution. The essential retail, which always did well for us, we saw some softness in the last quarter, but hopefully that should turn around given the festive season that is ahead of us, right? So we'll have to wait and see. But overall, manufacturing looks strong in both Europe as well as in North America. Retail, we have to wait and see. And then travel, hospitality, we hope that it will also turn around during the festive season and the holiday season ahead.
You are one of the largest employers, and I was reading some commentary yesterday which said that at your current employee size, you are larger than many state governments, and obviously this is a good way of analyzing your headcount numbers. But the headcount numbers seem to have declined by over 6,000 in the second quarter, and as far as the attrition, it's at 14.9%. So, what is the outlook as far as hiring is concerned? Is this a stable number that you will be at for the rest of the year?
See, we continue to hire, and we continue to hire the talent that we need. But if you really look at that 6,000 net headcount drop, this is nothing to see as a layoff or anything that we did. It's predominantly during the last about 12 to 14 months, we hired a lot of people, a lot of people from the market laterally as well as freshers. They all went through the training, they're all ready, and we have a bench at strength, right? And as you know, every quarter we calibrate the lateral hirings that we need to do based on the market demand and in addition to what we have. So, be that as it may, I think in the current quarter which passed by, Q2, our demand, whatever we were able to fulfill majority of them through internal resource pools that we had. And we also had replaced some of the contract staff that we had with the bench strength that we have. So the net, in net, what happened is that, look, we reduced the subcontractor count. We were able to fulfill the requirements that came in with the internal resources. We hired some lateral talent, and then there were natural attrition that people left TCS. In this quarter, the net attrition that happened in that sense exceeded the typical hiring that we do, right? In that sense that the 6,000 net headcount happened. But overall, nothing to worry about, and we continue to calibrate the workforce that we need, whether laterally or through freshers. Our freshers hiring program for 2024 remains intact. We have started going to the campuses and meeting people. So we continue to hire the right talent that we need. At the same time, optimize the bench strength that we have, improve utilization, and deliver a better margin as well as execute well, Siddharth.
For the record, since you mentioned campus placements, there were some reports on delays, and that was not just for your company, but broadly across the sector, and also questions on variable payouts. What would you say to that? Have full payouts been made, and all the offers that had been made, have they been fulfilled?
Firstly, I think, we communicate to all the people whom we hire certain date range, this quarter, in this month, join us. I think, barring one or two instances where we had to push it by a week or two, largely that was according to plan. Every single offer that we have made to the freshers as well as the laterals during the year have been honored, and we'll continue to honor them. So our onboarding program is fairly intact. That's the first point. With respect to the variable pay for this quarter, 100% variable pay will be granted to about 70% of our workforce. The remaining 30% will be based on calibration of their individual performance, and so on, which is typically the case for us in every quarter.
Absolutely. And one of the other points that I want to pick up on this matter, the last one on the human resources aspect, is the shift from hybrid to back to work. What can you say to all those people? Because this is something that has been closely watched in the workforce all across India.
We have been working with our employees and advising them to come back to offices. There are multiple reasons for it. I'll just step back and tell you, Siddharth, that when the pandemic struck, we enabled working remotely for all our employees within a matter of about 10 days, right? So our processes and systems, whether it is security or whether it is continuously, we innovated as far as enabling people to be contributing and to the growth of TCS, contributing to the projects in which we are working for our clients. All that remained intact. Having said that, what happened was that in the last about 6 quarters, a number of people left TCS. The industry had a huge, you all termed it as a great attrition. And a number of people who joined TCS were also huge, right? Close to about, let's say, roughly 150 to 200,000 employees have joined TCS afresh from the market, either it is from the universities or otherwise. So in that context, what we felt is that it's important that they all come back to work, come back to the offices, work with the senior colleagues, understand the TCS culture, understand the TCS way of working, how client interactions take place, how some of the labs that we have within the campuses are typically used to prototype and craft solutions quickly and then position it and demonstrate it to the customers as the overall value proposition. All these things matter. And we felt that, look, given the workforce that the fresher workforce that we have in fairly large numbers, we felt that that is the right thing to do. So we have asked every one of our employees to come back to office 5 days a week.
Wonderful news there, and thank you for setting this record straight. I want to talk about the outlook that you feel as far as currency trends are concerned. Your constant currency revenue growth is up 2.8% year on year. What do you visualize happening?
We would like to grow, no doubt about it. We are all focused to grow the business. And as I said, the order books look strong. But in any quarter, what happens is that there is a fixed base of work that we currently doing. In this quarter, for example, what happened was a couple of large transformation programs that we executed, they got finished. So which essentially meant that, look, typical revenue that we accrue from that project goes away and it needs to be replenished sufficiently with the new deals that we are winning. And in addition that, the existing projects continue to get optimized. Our customers look for what we call as the run the business, bring in automation, disrupt yourself, automate it, so that, it's like, milking the run the business to feed the change the business. That's the concept that we all practice.